But I think that in the short term, we will probably see more pain and more blood on the streets, and that's going to eventually create a new dynamic which we haven't had in some time, which is an increase in inventory, which I'm hopeful we'll see in the next probably 6 to 12 months. Because the reality is that there is a lag between how long it takes for people to default on their payments, and when the rates actually go up. Like if you look at the historical data, the lag is about 18 months.
Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. All right, Konstantin Polyakov, thanks so much for coming on.
Thanks, Adam.
I mean, you're super experienced in the field. How long have you been doing mortgages and financing and just that kind of thing?
11, 12 years now.
11 or 12 years. You've seen all different kinds of markets. You got a pretty good head on your shoulders, I'd say. And you also got a good understanding of the way the financial system works. What the hell is going on right now? I mean, headlines are all over the place. Tell me what your thoughts are.
Well, we are experiencing two great dynamics. We're experiencing our government trying to fight inflation, and we're experiencing a very crazy cost of borrowing that we haven't seen in a long time for consumers. And the combination of those two is making everybody's life a living hell.
Tell me about the cost of borrowing and the fight against inflation. At the broader scale, kind of, are we being successful at it? Is what we're doing worth the cost?
Interesting that you put it that way. We don't have any choice. We don't really have any choice, right? The reality is that we've been keeping rates so low for so long that any change in the interest rate was going to be noticeable, right? If it was a 1% change, people would be complaining that the payments are a little too high. I mean, they're not just 1% more than they were at last renewal or last time that you got a mortgage. They're quite a bit higher than that. So really, I mean, there's not a lot you can do but deal with it, right? And what I mean by that is what people have been trying to do. They've been trying to cash flow best they can, right? In terms of the people's ability to cash flow their property and cash flow their households, it has been very challenging. Inflation isn't just in the mortgage payments, which is very significant, but inflation has also been very significant across all other categories, right? Like food category is one of the categories that I think is very noticeable for everybody. I think the last report came out with something just a little bit over 8% in that category alone. So the overall cost of living has gotten up, and the cost of borrowing will stay high until the overall inflation subsides, which means that the government wants us to stop spending and it wants to see some deflation. And if we're seeing a little bit of that improvement in the inflation rate for a period of time that's consistent and predictable, then we will be seeing some decrease in the cost of borrowing, but not until then. And kind of segue from this point on, something else I was mentioning a little bit earlier while we're just sitting down. One of the most recent posts and reports from Benjamin Tal, I think we all know who that is. If you don't, look him up.
He's the chief economist for CIBC.
That is correct.
Super smart guy.
Very, very smart man. So he said something very interesting. And he pointed out that these swings in the interest rates, although they have been very significant and very noticeable, they are, for the most part, they've been nothing but blips in terms of what they've done to the real estate market for now. And what we've been seeing is that every time the rates go up a little bit, everybody's confidence goes down and the market freezes for a little while. And then it sort of blooms a little bit once everybody is predicting that maybe the rates will stay stable. And the second there's some predictability in the way the rates react and the rates behave, people go, okay, I think I can do this, right? And then they go out and start looking at properties and buying, and the market sort of picks up again. And so what's going to happen, and I said this like a year ago, and I'm going to stand by this exact same statement today, we are going to play this dance where the Bank of Canada will keep jacking up the rates, every time we'll see the inflation rate stay unsatisfactory, right? And so only after we have stabilized the inflation, we stabilize it for a significant period of time, will we see any decrease in the cost of borrowing. Until then, just buckle up. It's going to be very tight, and it's not going to get better for quite some time, based on what we're seeing right now. Now, there's also possibilities of black swans that could still happen. They could maybe throw market into a different direction, right? Like we've actually seen rates decrease quite a bit in the preceding months, in the months of May and April, because there was some ambiguity about what was happening down south in the States with their banking industry. So whenever you have situations that are very unpredictable, everything will sort of take weird turns often, and during those periods, everybody's going to get very scared, right? And or they'll get very opportunistic depending on who it is. Like even in a market like today, where markets, the interest rates are very high and the cost of borrowing is high, to say that there are no transactions is wrong. Like there are transactions out there in terms of purchase transactions. It's not your typical summer season or your spring season earlier where everything was flying off the shelves. First of all, there's no inventory, as you know, right? Like the inventory is low. It has been low for the past little while, even though we're seeing a bit more availability right now. And so when the market is tight and there's not a lot of inventory, like the second there's a little bit of stability, everybody goes out and looks for a property, whoever can afford it, right? And the category that I'm talking about, the ones that are opportunistic right now and are able to afford it, are people who have cash. Like if you have cash right now to go out and buy a property, you could go and find deals. Like there, and this is kind of leading me on to the next topic as to the categories of people that are still transacting and which ones of those categories are bleeding the most, right? So let's say if you're an investor and you're looking for an opportunity, your first segment of the market that is bleeding the most is people who bought last year, the year before, and they had a private mortgage and they were expecting to refinance on maturity and maybe wrap some of the additional balances into it, some of the renovation costs, maybe some additional debt they accrued as a result of the last year or 2 years of high payments, right? But if you're not in a position to really renew because you don't have any more room and your appraisal is coming in very low, and the lender is asking for you to dispose of the property, you're left no option but to list the property and sell. And I've seen some things recently where certain properties that were investment properties that were listed for X, let's say 699,000, 700,000, right? And then we've seen them sit on the market for about a month. Boom, the rate hikes comes out. The seller gets a little bit worried and scared and anxious, even though they originally were hoping for probably well above 700,000 of an offer, because they were looking to lure all those people searching at properties below 700,000, right, to see if they can get them through the door, take a look and see if they will place an offer. The reality is that the property ended up selling for somewhere in about $100,000 below, $70,000, $80,000 below the asking price, because the seller had to deal with the mortgage that was maturing, and it was a really quick closing. Like somebody just went in and said, hey, I'll just give you this much. And the seller looks at it and says, if I have to renew the private mortgage, like a lot of these private mortgages have very, very prohibitive terms. Like they'll have a renewal, they'll have, let's say 1%, 2%, 3% of a fee. If you think about the size of the mortgage, is quite significant. And then on top of that, there may be an increase to the payments because there have been some rate hikes, right? And on top of that, like, if you don't have the fee to pay, plus your property deflated in value, like that's a recipe for disaster. All right.
I do want to kind of like step in and just kind of try to dovetail a few of these things, because you touched on so many things right there, and that was just so dense. Sorry. It's great. Like there's a ton of information. You're a wealth of knowledge, and I just kind of want to try to, I guess, unpack a few of these things with you a little bit deeper so that people can kind of really get a grip on what's going on. So the first thing that you mentioned was people being scared versus people being opportunistic.
Mm-hmm.
My podcast is still young, but the most successful episode that I had was with my broker of record, Vivian Risi, who is, just a beast of a businesswoman, and she's been doing this for a long time. And that was one thing that she kept on really hammering home, is that there's a ton of opportunity right now for those who are willing to stomach it. And another thing that you mentioned that I wanted to kind of dovetail with that was that a lot of people are talking about affordability as being a crisis. But at the same time, we're seeing that the only time the market stops going up is when the predictability of the future becomes opaque. But the second that there is stability, even though things are extremely unaffordable with high rates of high cost of borrowing, then things just keep trucking along back uphill in terms of price. So what we have here, from what I'm understanding, is not so much a issue of the high cost of borrowing for the Toronto market in terms of prices, but just the opaque future, unpredictability. And then the second we resume any semblance of predictability, boom, it starts right back up again. So what we've been seeing, at least from what I can tell, is a huge amount of pressure being put on the Bank of Canada, and for good reason, because, I mean, hey, they say one thing and then, they do something completely different the next day. And they're kind of jumping back and forth, telling us, hey, it's going to be one way, and then it ends up being another. And I mean, there's been a lot of criticism hurled at the Bank of Canada for this, just like incongruency between what they're saying and what they're doing. So that kind of brings me to that next question of predictability. We're going to see another interest rate announcement in less than 2 weeks, right? About a week and a half from now, right? We're shooting this on July 4th. Oh, July 4th. Happy July 4th.
Happy July 4th.
I'm Canadian, whatever. But what do you think is going to happen? What can you speak to in terms of what the Bank of Canada is saying versus what they're doing? And what should we be expecting? Because predictability is the name of the game here. It's not the cost of borrowing, it seems.
So first of all, predictability. Like, predicting economics is really hard. I mean, I think if you took a bag of 100 analysts that have, years of experience, and you actually got them to predict things, or you just flipped a coin to see, which ones of those predictions would go left or right, I think it would actually come down to the law of regression, where it would ultimately regress to the mean. It's very hard to predict exactly how it's going to turn out, but what I can say is that predictability of what's ahead of us can only be judged by, well, not only, but I'd say the two main factors that everybody should be paying attention to is the inflation rate, right? So the inflation rate is a good indicator of what we can expect in terms of what the Bank of Canada has to do, because the pressures of what the Bank of Canada has to do come a lot from the inflation reports, right? So when we're seeing the inflation go up, I think it's fair to predict that we'll probably see some rates increase as well. But then the question becomes, well, how is it affecting the buyer if they buy it today? Like, what is really the fear behind buying something today? All right, paying whatever price you pay, whether it's a deal or not, you got a fair price, let's say, and then the unpredictability of future. Like, for example, if you already have an approval, like pre-approval today, okay, so that means you know what your mortgage is going to be for the next 3 to 4 to 5 years. It means that you've locked in your rate. Okay, so let's say you've already established there's predictability in what you can afford to a certain degree, because you have to make sure that you fulfill that contract, that purchase, within the 90 to 105 day period that you have for the pre-approval. Okay, so let's say that there is some predictability in your cost of borrowing, but the unpredictability that we have now is to do with, well, what happens after I buy, right? And I think there is two main psychological concepts that are at play. And the first one is loss aversion. So we naturally are we don't like as humans, we don't like to take risks where we're more likely to lose than we're to win, or the reward for winning isn't great enough. Like, there's a very famous experiment where they take, I think, $45 they offer to you as, like, if you, let's say, like, we're two people in the experiment. I say, hey, here's $45. I'm gonna flip a coin. And if I get tails, then I earn 100, right? But if I don't get tails, then you keep the 45. So like $100 is enough for me to want to play the game. But if you make it like 80, it's almost not enough. So there is that element where we have aversion to loss. So whenever you're talking about, let's say, going out and buying a property, the problem is that, like, you're going out there and you're looking at property, but your greatest fear is unpredictability of what happens after. As an investor, as a smart investor, you look at that, but you also look at cash flow on the project based on what it is, right? So there is some predictability as an investor as to what you can expect in the carrying cost of the property you're looking to buy. And there is some unpredictability from where the market will be after you buy it. But if you're signing a contract on a mortgage for 3 to 4 to 5 years, you have essentially established your sort of your budget, right? So it's a little bit easier in that sense, I think, to stomach the purchase. If we're trying to determine how to justify or how to explain or how to make sense of an opportunity in the market like this, right? Because like a good example of how people were making sense of this is when the rates were going down a little bit in the month of April and May. People were reaching out to me and saying, hey, like, I see that, we're entering a little more affordable rate market. Like maybe if I can stabilize a purchase now, right? Regardless of what happens for the next 3 to 4 to 12 to 24 months, like how do the numbers work? And I like that question because that means that the person is looking at the specific project and affordability of that project without any speculation on appreciation value, for example, right? Looking at the fundamentals of real estate, they're looking to make sure that the property cash flows on its own or cash flows based on their budget. So like, I think that dealing with the unpredictable nature of real estate and interest rates comes down to making sure that when you're entering the transaction, the fundamentals of that transaction make sense to you and the cash flow in it also does based on what's in front of you, right? What happens in 3 to 4 to 5 years, I mean, it's all just time in hand. Like the longer you hold real estate, the better it is as an investment for you long term. I mean, buying properties and flipping them a year later is a dangerous business. So as long as the person looking into the real estate purchase understands these dynamics and they understand that there is predictability in their cost of borrowing and there is predictability as to what they can expect from this specific project, as long as they do the math right, well, then the unpredictability of the future and the market in front of them is secondary to it.
Now, what you're also referring to is a little bit of risk tolerance. And I'm finding,
Right.
This is the cool thing that I'm finding. And I think on your side of things, because you see people's financials, I mean, intimately, right? You know everything. Is it right in me assuming that the younger people are, before they are in their maximum, statistically, maximum earning potential years or approaching their statistical maximum earning potential years, are much more, ready to stomach that risk?
And it's yes and no. So talking about risk, so we talked about the idea of loss aversion, right? This idea that the benefit has to be significantly greater for you than the loss for you to consider some sort of a risk. So the second problem is, and we're gonna get back to this topic in a minute. I just wanted to segue into something else. Is also that whenever you buy something, there is this part of your lizard brain or your Neanderthal DNA that is just doesn't want you to let it go, right? So like for young people to enter the market right now, a lot of them have been, let's say, earning for the past 5, 6, 7, 10 years because they've had their careers and their jobs and whatnot. And they've been investing into, let's say, stocks, right? And the stocks seem to have been kind of inconsistent in a lot of ways because they've been making money for some time and then they were losing money for some time and they were making it again. And then I'm not sure exactly where your portfolio is, but I'm sure you're still bleeding. So, like if you give somebody an item that has utility to it, like a home, they will stand by it and they'll suffer. So their ability to deal with the initial purchase is tricky because they don't know what they're getting into, and because they have no point of reference in buying and selling properties, they have a really hard time making that first step. So they're actually typically less likely to take a risk on something. A good example, I had a customer who was buying his first property, started working with him right around the pandemic. Took him 3 years to figure out. He placed offers, he had them accepted, got cold field pulled out, right? A couple of times. Eventually, he found something he got a sense of a comfort level, and he had a much easier time going through with the transaction because he knew what to expect at each different milestone. So to answer your question, I'd say that younger people and people entering the market for the first time are naturally less likely to take risks on that first purchase. It takes quite a bit more making sense of the transaction for them to really pull the plug. Whereas somebody who has sold and bought is going to be a little bit more fluid. They're going to naturally have a little bit more risk tolerance towards disposing of an asset and making an offer on another asset.
So you're saying the exposure to the real estate market transaction breeds comfort, and so people are naturally going to be more comfortable with the first time buyer.
So there's actually also a very interesting experiment that they did, I think back in the 80s, where they took a bunch of people and they, I think it was like the first experiment, they gave them a bunch of tokens to see if they could just trade tokens, and somebody would eventually have more tokens, which would make sense. Like, you trade enough things and over a long period of time, somebody will have more of it. But people were very reckless with the way they were trading tokens. And then they exchanged tokens for mugs, and like they were decoratively arranged, and it looked sort of interesting, and had some sort of an interesting visual value to them all of a sudden, but more just a token that had no real value to it. And when people had something that they liked, they would actually sort of assign more value to it by virtue of having it, as opposed to just something that they can't utilize, right? So when we're talking about real estate, something that is going to be utilizable as a home or as an investment property, like once the first time buyer is past that initial anxiety and they have the property, they're also more likely to keep it for longer. So like a lot of the time, if you look at statistics of the first purchase that people make, they typically hold that property for a little longer than the property they buy consecutively. And so in that experiment when people were trading the mugs, interesting thing happened is that the more people traded, the more likely they were to trade again, even because they got a hang of it and they were able to make more sense of value on the spot, and they were able to make decisions more decisively, right? They weren't so afraid of making a decision, and they had less of a loss aversion than the other people. So like that gives you kind of a tip as to how we also trade real estate. Like if you look at people who will buy homes and they also don't really want to sell, a lot of the time is because they've already assigned additional value to it that they didn't have before, because they naturally, it's much harder to let go of things than it is to get excited about new ones. So like this market is going to be actually quite tough for realtors working with first-time buyers, I would say, more so than with investors. You'll have much easier time dealing with investors who are a lot more seasoned to stomach the risk up front, as opposed to a first-time buyer who isn't used to this. And every step is making them very anxious. Like, like they're not sure, like, how much is the land transfer tax? I don't even know how much do I even have enough money? Like, how much are the interest rates? What are the payments? What's 30-year amortization? What's amortization? Like, it's just, everything is just so overwhelming, as opposed to somebody who have had the experience of stomaching it at least once or twice.
Right? So I guess going back to risk now and stomaching risk and the predictability, which is what determines people's perception of risk.
Yeah.
Because we don't actually know what the risks are, right? We just have the perception of risk.
Mm-hmm.
We have an interest rate announcement coming up. In so far, you've said keep an eye on the inflation rate.
Yeah.
When we're looking at the inflation rate, there are a few big factors when it comes to inflation. I said this in a YouTube short recently, and like people were like blasting me in the comments because I said that government spending is inflationary.
Well, any amount of money that you print and you spend on things will essentially be spending. Like, there's no more making. I mean, you have to spend money to get out of places that are difficult like this. Like if we just don't do anything and we don't spend the money on let's say reinventing the economy after it tanks, which it will in the next little while. Like I think we probably have more spending ahead as well. Like it's going to be very difficult to balance everything. There's not yet answer.
Yeah, and how are we how is the politicization of government spending in particular affecting the predictability of risk with interest rates going up in order to battle the inflation rate? Like there seems to be a huge polarizing discussion around this. Is public spending and public debt inflationary or not?
I am going to suggest that we should probably let the government. We should give the government the ability to make some decisions that unfortunately we don't have any control of, and they have to make them to the best of their knowledge, right? So if the government chooses to spend money in when the Bank of Canada does do what they do in the next 12 to 16 months or 18 months, if we're in a position where we can spend more money and we're not experiencing crazy inflation that we are, then that would be a way for us to come back out of a rather tanked economy, because it will probably end up taking the economy. We don't have a choice. We have to like I said, bring the inflation below the allowable limit. But hopefully not until then. I'm hopeful that we can prevent any more spending until we are in a much better position.
So ideally, we slow spending, we slow money printing, which tames a bit of inflation.
Raise the rates, right? Make things unaffordable in addition to that. And then with hopefully the next 12 months, we'll see us stabilize the economy to a degree that will be manageable.
When people say a soft landing versus a crash, what does that mean to you?
Like the thing is, every time that we've seen us approach a crash or a situation where it's maybe appearing like we may be entering a crash, something happens and the government sort of prints more money or put something together and works it out. I think the way to stabilize the economy is going to be to bring the economy as close to a crash as possible, and then not let it crash for as long as you can.
So walk up to the can, but then kick the can down the road.
Yeah.
Okay. And we seem to have been doing that for a little bit.
And we will probably keep doing that for a little bit longer, for quite a bit longer, actually.
One thing that I've noticed, and I want to get your take on this as well, because, I mean, hold on, wait a second. You still haven't answered my question. What do you think is going to happen on July 12th, which is my birthday, by the way? So
July 12th, the Bank of Canada is going to award Adam Nadler with a birthday gift, and it's going to be a 25 basis points rate hike.
Okay. God damn it. Well, there you have it. We can end the interview here.
there's the thing is that if they don't, then what's going to happen? There's obviously the inflation rate, which actually seemed to improve last month, but there's also like the problem of the market picking up in the preceding months. Like we probably do want to see the market stay under a lot of pressure for the next few months if we want to see no more increases in the inflation rate, because like if we just let the rates roam, then we again have the same problem we talked about at the beginning. We have the problem of predictability. So then once things become predictable, the investors and the buyers that are sitting on the sidelines right now will feel a little more confidence and go out and start really spiking the attention to real estate market. But if we see again more tension for the next few months, and then we enter the fall market, right? Like people will still buy homes, but it won't be bidding wars. 10 to 20 people bidding on the same home. Like again, with a certain degree of predictability, long term, people will still make moves, right? But I think that in the short term, we will probably see more pain and more blood on the streets, and that's going to eventually create a new dynamic which we haven't had in some time, which is an increase in inventory, which I'm hopeful we'll see in the next probably 6 to 12 months. Because the reality is that there is a lag between how long it takes for people to default on their payments, and when the rates actually go up. Like if you look at the historical data, the lag is about 18 months, right?
But here's the thing, is that the people who had bought in the peak of the market, who had those variable rates with a static payment, I mean, the banks didn't seem to care. They just extended everybody's amortization, and that seemed to have been a neat accounting trick. So
for now, for now. Like there has been, so OSFI is talking, is having a hearing on this. I don't remember when exactly. I just saw this yesterday, I think, where they are discussing the matters of those mortgages where amortization ran away with static payments. And they're probably going to, I'm estimating that product will be gone from the shelves and we'll never see it again.
Wow. Really?
Yeah.
Talk about losing predictability. That was like the product that gave predictability to a consumer.
Yeah, it showed that when there's things like this, like when there's crazy dynamic and there's crazy movement in the market rates, and interest rates, it can really change the way your portfolio looks, like as far as the bank's portfolio with these mortgages, right? Because their amortization went well over 30% on like 20 something, depending on which bank, but like over 20% most banks, like their amortization went over 30 years, which is crazy. So OSFI, I think, isn't about to let that happen again. And that was like a nice product to have. It's for those of you that don't know, the difference between what we're talking about and the variable rate mortgage where your payments do adjust with the interest rate hikes is that on a static payment mortgage, your payments don't, but your amortization changes, right? So if, let's say, interest rates go up and the cost of borrowing goes up with it, the amortization extends to sort of take care of the difference in which you're supposed to pay towards interest for the most part, not so much principal. Principal, actually, the portion shrinks significantly.
And we saw people hit their trigger rate where there was no principal anymore.
Yeah, there was no more principal. In those cases, like we'll see what happens next. You'll probably have to come up with, like, the bank will give you the options of probably either paying up the difference so they can retain the same amortization as they originally had, right? So let's say you haven't been making any principal pay downs for like a couple of years and your maturity comes due. Like it's quite possible that you might have to requalify, essentially, like refinance.
But
you have to refinance the amortization again.
Right. And who's going to finance a deal with a mortgage that's amortized by 45 years?
No, what's going to happen is you'll have to reamortize it over 30. So you won't have, so the payments will have to just change. Like if you're coming due for renewal and you had that extended amortization that went over, let's say, 35 or 40 years, and now you're due. Like again, I'm not sure how each individual bank is dealing with it, but I think there'll be a point where the option will be to either refinance, meaning that you're going to reamortize the loan again, typically over 30 years, because there is no more 30-year amortization through most big five banks. And then if you don't want to reamortize it or you can't requalify it, well, then the next option, the easiest option, is just to pay the difference. Like if you haven't been paying the principal pay down and you have amortization of, let's say, 21 years left or 20 years left, well, okay, well, you could probably pay down the difference of what you should have been paying on the principal, but you haven't been. And now you're sort of back to where you should be, but then the payments now will change because the interest rate adjusts.
So either a lump sum or they'll work it into a payment plan.
Yeah, something like that. I'm not 100% sure how they're going to deal with it yet. Not a lot, I think, of this has happened where it's become a problem yet, but we'll see how we're going to deal with this problem long term, because it will happen more often next year and the year after.
Couple things I want to ask you, because you're just we're going deep real quick and I like it. The one thing that I have been noticing that has really been propping the market up, from what I can tell anyways, is immigration at a scale that we have never seen before in Canada. Yeah. And a lot of that immigration has been through our economic programs, about 60% of it, which is very unlike our neighbors to the south, which have about 60 or 70% of their immigration through family. And so our point system has been weighting a lot heavier on people essentially bringing money into the country and propping up our dollar, propping up our economy. But it's also putting a lot of pressure on housing, both in the rental market and the resale market. How is it that we are going to simultaneously slow down the economy, slow down spending, government spending, both private and public debt, raise interest rates, yet also surge demand at unprecedented levels through immigration? That seems like diametrically opposed forces, kind of just, we have unstoppable force meeting an immovable object. And on top of all that, I wanted to ask you, when people do come to this country and they do have a down payment to buy something when they get here, first they're going to hit the rental market, which we've seen, and that's been absolutely flooded with demand. Once they've stayed here, how long does it take for somebody to build up enough credit to be able to actually do everything that they need to do in order to take the money that they brought to Canada and make a purchase? So how long does the money need to be here? How does the money get here? How long does it take to build up the credit? I mean, walk us through that, because immigration is, and how many files have you been seeing like that? Like, tell me from your perspective, what's been going on with immigration?
So, we do have, like, we're a Western country, and we do have like problems with birth rates. And if we don't consider immigration as a way of replenishing our human capital, we would probably disappear from the face of the earth in the next, 100 to 200 years. Like, we don't have enough of a birth rate in North America to I guess accommodate the aging population. So the immigration that we are doing right now, like, I think it's a little intense, what we've seen in the last 12 months specifically. Should have been done a lot more gradually. Because anytime you have an influx of that many people in any specific municipality, like, there just isn't enough beds to house everybody, right? And so I don't, sometimes, like, when you look at the way our government does things, it doesn't seem like the two departments talk to one another. Like, you would expect that the immigration department would be trying to sort of coordinate this housing issue that we're having in the big metropolitan areas and even outside of metropolitan areas. And it seems that there is just a lot of there's very little clarity between the two of them as to what how they're doing it cohesively. So people that are coming to Canada, especially in the last 12 months, for the most part, if I do understand correctly, a lot of them are skilled workers. So a lot of them will be able to obtain employment that'll be meaningful, meaning that they're going to be making a reasonable amount of money. And I'm not an immigration specialist, so I apologize if when I say most people and things like that is largely incorrect. But based on the application that I have seen, a lot of the applicants that do come to Canada are skilled workers. A lot of the time it's workers that are working in IT, they're working in construction, they're working in very specific, unique fields, like it could be 3D modeling or some sort of artistic work that requires like a high level of skill. And so those individuals coming to Canada don't often have a lot of down payment, and I think that becomes the biggest challenge for somebody trying to start a new household in Canada, fresh off the boat. So if you just landed in Canada and you got your position, you got a decent salary, you're earning a living, you're going to enter the rental market first. And during that period, it's important that you start considering the factors that will contribute towards your ability to buy a home later. And those things are making sure that your employment is stable, and you're stabilizing your employment if it isn't. Let's say if your job is casual, it would be nice if it could be converted into full-time and not casual, but permanent, right? It's working on your credit. And when I say working on the credit, it's developing good credit habits. Like, a lot of people, when they come to a place like Canada, haven't been exposed to the credit system for long enough to fully understand the mechanics of how it works. And this is when it's a good idea to start talking to a credit professional, perhaps a mortgage broker, so they can sort of guide you through some of the very basic requirements as to what the banks are going to look for when your mortgage application comes through, right? And so the first thing would be establishing a bank account, right? Making sure that you have a bank account in a relationship with a bank that understands your income, at least to a certain degree. Second would be applying for probably a prepaid credit card, something that will allow you to obtain credit, because when you don't have credit, nobody wants to give you any credit. So prepaying credit card, sorry, I shouldn't say prepaid, I should say secured. Prepaid credit card is just something that you put money on the actual card and you just swipe it and use it. There is no record of it. A secured card is the one where you put security towards the card, let's say $500 to $1,000, and then the bank issues you credit for it, and they hold the security. And that is reported to the credit bureaus. And if you talk to a knowledgeable mortgage broker, they'll be able to guide you to the credit card companies that can help you establish those first credit line. I would recommend getting two, because this is the minimum requirement for CMHC, which is the governing body that ensures mortgage financing, and you will need it, especially if you have less than 20% down. And so getting a credit card, preferably two, because that's going to be the minimum requirement for CMHC. And in combination with your history of rental payments, combination with a history of your phone bill, you can actually apply for a mortgage with CMHC insurance, like, let's say 9 to 12 months after you land here with very little credit, with a very thin credit report, using the, what is it called? New to Canada program. Those programs are available. The main challenge with those programs is that when you're using the New to Canada program that is insured through CMHC or one of the other insurers, the main challenge is that you are using 25-year amortization to qualify and a stress test of like upwards of 7% right now, because rates are about 5 on average. And so the main challenge is just how much you can afford, right? Like a year ago was different. 2 years ago was very different. But like right now, if you make $100,000 on a base salary, like your mortgage limit is roughly about 400,000, maybe a little bit less, right? If you are using CMHC insured loan programs, again, like that's not a lot to buy in the city. So a lot of the time you have to look probably outside of the city, and if your work doesn't allow remote work, it becomes a bit of a challenge. So like what I would recommend for somebody who is new to Canada is, if you're in a position to bring equity from back home, whether you had a property back home or your family could potentially consider an early inheritance for you, having 20% down payment significantly improves your ability to buy a property and to qualify for a mortgage, because you no longer need to qualify for CMHC insurance. You just need a bank that's willing to consider the file for what it is. So when you're a skilled worker, you're making good money, your repayment history is decent for the last 12 months, and you have, let's say, 20% down, that $100,000 worth of income starts to get you quite a bit more. And what I mean by that is, where your loan before this was in the high 300s to $400,000, with 20% down payment, we can start looking at ranges of 600,000, maybe 650 and change, that will allow you to approach properties within the price range that is available out there, right? Within inventory that's available out in the market today. And so that's one of the ways that we've been dealing with a lot of new to Canada applicants, is just helping them understand that there is an insured pathway that requires for you to qualify with CMHC or one of the other insurers. It's a little bit more difficult to qualify because the guidelines are a little more stringent. And then you have the second way of qualifying, which is more of a conventional way of qualifying. And because if you do have the 20% down payment, you don't need insurance. There are other lenders, like alternative lenders, including credit unions and trust companies, that will use often no stress test, and they will use 35 or 40-year amortization, and they'll be able to service the payments and figure out a mortgage that would actually make sense. And so that's one of the comments I'm going to say for that. One more note I will say, I think that one of the other ways a lot of new to Canada applicants could consider this first investment of theirs is, if you look at properties that could potentially generate an additional source of income, whether it's from a basement rental that's legal or it's a duplex property that you're buying, that's often been a really nice way of cash flowing the property out, right? Because if you have, let's say, a duplex somewhere in GTA or a little bit ahead of GTA that generates a couple of grand extra for a unit upstairs or downstairs or a side or whatnot, well, then your monthly payments will make a little bit more sense. You could probably qualify the mortgage better, and you could cash flow the household better as well. So I would say that what we'll probably see is, in the next 5 to 10 years, we'll see a lot more regular single detached dwellings or whatnot converted to some sort of duplex units or triplex units, and we'll be looking to densify areas. And those properties, if they're within an affordable range in terms of their purchase price, will become quite useful for those looking to cash flow out their first purchase, because they do come with an additional source.
Wonderful. That's like massive, huge advice for anybody watching or listening. I mean, there's so much information here and it's so dense.
Yeah, it is a lot of information. I'm sorry, guys. A lot of this stuff is very specific, right? And I can also just blabber away for hours on end. Because when you're passionate about something and you see it day in and day out, I mean, I do like to share. But it is a lot of information. Like, I would say, if you're new to Canada and you're trying to figure out your first purchase, your first stop is probably a mortgage broker. Like somebody who's dealt with new to Canada applications and knows their way around them. because they will be able to guide you through the requirements that you need to be aware of before you start going out there and looking at homes. There's almost no point to look at homes unless there is a solution for you to use to actually finance the property.
And it's all anecdotal to the individual. So
Yeah,
you've really got to speak to somebody.
it's very unique. Some people will have they'll have a family that is willing to help with a little bit of down payment, right? Some of those people will have maybe a property overseas that they just forgot to mention, but yet they're also making a little bit extra money from that. Some of the people will have maybe a family member here in Canada who doesn't mind co-signing for a few years, like helping you qualify. That's also an option. Like I've done that before, right? Some of them will have a lot of cash because they just sold something overseas and they're looking to buy it here, but they don't have any income at all. Like, how do you do that? Believe it or not, there actually are programs that are geared towards people that just have significant net worth. And those programs are available through the broker channel on both A side of business and B side of business, whether you have credit, whether you don't, right? Whether you have very, very little credit. So, like, there is a variety of options when you are looking at purchasing and financing a property, but the first stop is figuring out what can you actually qualify based on your current situation. If you can figure it out right now, the mortgage broker will typically tell you what you're missing to be able to qualify for it later, right? Let's say you make a plan to talk in 3 months or in 6 months. And maybe in those months, he said, like, listen, you really need to get a credit card. Like, you have no credit, zero credit whatsoever. Like, just at least something while we're figuring out the rest. And you're waiting for your probation to end. Like, right, that's another thing as well. If you're recently employed and your probation isn't over, you have to wait until it's over.
This is huge information for everybody who is listening, watching. And one thing that I wanted to ask you about that has nothing to do with anything, but I just think it's super cool.
Sure.
And also, we're starting to run close on our time, just because this is just going to be too much for me to edit. If I don't put a stop to it at some point. But I agree. But I did want to ask you about you're a black belt in Brazilian Jiu-Jitsu.
Yeah.
Talk to me about that. That is like the coolest thing ever. How did you start on that journey? And you compete now. What?
I mean, I cannot compete right now because I got recently injured, but I've been doing jiu-jitsu for about as long as I've been doing mortgages. That's the truth of the answer.
Over 10 years you've been practicing.
Yeah, I started. It's funny that this actually came up like that, but I just started doing. Got into jiu-jitsu after years of doing judo and other martial arts, and I fell in love with it because it's a great workout, and the very sport itself promotes a level of brotherhood and a level of support for its members and those that practice it that I never really found in other sports. Not to say that they don't exist, I just never found them, which is just my personal experience. And I found that getting into jiu-jitsu and starting getting into mortgages was having those two timelines happen at the same time was very unique in the sense that I got to see myself get better and sort of learn both concurrently. And the one thing I do believe that sports can help you in terms of business and just your overall journey and make your life a little more meaningful. It creates just a little bit more meaning outside of what you do for a living, right? Like I'd say that we all identify ourselves as what we do, and it's fair because we spend a lot of time doing things that we do, and so we kind of are what we are. I'm a mortgage broker. I do that most of my day. That is number one activity for what Konstantin spends his time on. But I think it's very important to have a sport or some sort of a hobby that creates that meaning on a side. That for example, for me, would be leading the team to the different tournaments. We travel a lot. We just recently came back from Paris. We went to France as a team of 3. Have 2 of my students with me. I got to coach them on a big arena, on a big mat. I got a chance to compete myself and sort of lead by example. And I think that's also very, very valuable and very powerful to your spirit because it allows you to shed the fears and face them in a way that you probably naturally would never do, but you are choosing to do it because it's exciting and it's challenging, and that's what life is about, right? It's about creating meaningful and exciting challenges that make life worth living. So doing jiu-jitsu has been a great way of clearing your head, making sure you stay fit, and also to continue sort of create that meaning on a side that is outside of what you do for a living, that is purely recreational, purely fun and joy. And I highly recommend to anybody who is interested in trying out a class. I think a lot of people would find it very interesting and exciting if they just gave it a shot.
Yeah, it's definitely something that.
But you get injured. That's one thing that you have to be aware of. Sports in general, you have to be prepared to take care of your health. You have to sleep well. You have to make sure you eat well, and make sure that you listen to your body, and you take rest when you need. I've been training for about 20 years between different martial arts. Luckily, mostly had no big accidents, no big injuries. Unfortunately, I did tear my meniscus back in March of 2023, just a few months ago. And I've only been walking for about a month. I was on crutches for quite some time. So it is ultimately still, there's some danger in sports, but I think that the danger is well justified because of the benefits that it does provide for your health and your life. And so, you could just walk and slip and fall and break your neck. And like the accidents happen no matter whether you participate in sports or you don't. But do watch safety first. Martial arts ultimately is especially if it is full contact, are prone to injuries, and it's important to make sure that you can stay healthy and keep training, as opposed to being in bed and waiting for your legs to heal or waiting for your knees to heal.
I noticed that you kind of talked about it almost in the ethereal sense of kind of what it does for your mind.
Yeah.
And your heart, which is a really cool thing. I used to be big into rock climbing, like huge into it. Got injured, haven't been the same since. But now I'm kind of like really, really deep into yoga. That's what I got. And for years now, just kind of started as like more of a rehab thing, just made me feel good. And now over the years, I've been doing yoga for like probably that same amount, probably over 10 years. And the deeper I go into it, the more I find that I'm appreciating that mental aspect of it more and more and more. It doesn't just make me feel good. Of course, it's a great workout, it makes me feel good. But getting to kind of understand the flow of the different instructors and understanding their way of taking you through their practice in their artistic expression of it, but also that mental aspect of when you're rolling with somebody in jiu-jitsu or you're trying to balance in some crazy yoga pose, there's nothing else that can occupy your mind in that moment.
That's right.
Right? And that kind of clearing your mind of anything else and being able to completely focus on just that current biological, physical thing at hand that's happening to you right now is, I think, an amazing antidote to all of the like constant stimulus and social media and stuff like that we have going on right now. So I wanted to ask you about it because I just find it so cool.
Oh, absolutely. I'd say that it's just, they talk, if you talk about depression, from just a little side topic, they talk about depression as a psychological concept. Depression is when you have, sorry, let me just rephrase this. Depression will persist the longer you choose not to break the cycle. So like for me, let's say keeping clarity of mind and keeping yourself healthy emotionally is being able to break out of the cycle that is negative, right? And one of the greatest ways to break out of a negative cycle is by trying to distract your attention onto something else. Like the reason that jiu-jitsu, I do it religiously, like daily. Like I do jiu-jitsu from Monday to Friday, and I still go on Sundays, and I still spar for like 4 to 5 hours. But I think that it's just very therapeutic for me, like you said, because when I'm doing it, I can't think of anything else. It breaks patterns of thought that have been polluting my mind since the previous day or since morning, right?
Well, you have a very demanding job. How many employees do you have?
I don't have a lot of employees. There's only 3 of us, but I do have a lot of volume. So we are only a brokerage of 3 people, but we would do volume that would be respectable for a lot more people than that.
How many transactions a month are you guys?
Not transactions a month. I'd say like maybe about a dozen. like about half a dozen to a dozen. And then in terms of volume, I think last year we did close to 40 million. For 3 people, it's not bad. For 3 people, it's a lot of volume. Like it's a lot of calls. Like my call log is daily. There's like 30, 40 people I got to talk to, right? So this time that we're taking right now is me not calling people.
So basically there's your phone's blown up all day. So by the end of the day, you gotta kick someone's ass. You have to.
So what I actually do is I find that for me, exercise works best in the mornings because it gives me this adrenaline dump that I don't get any other way. So I typically teach from 7 a.m. until about 8. Would work out a little bit maybe until around 9 to get just some drills and things going, some stretches. And so I find that for me, it's clarity of mind post-exercise.
So you got to kick someone's ass early in the day so that you don't end up kicking someone's ass later in the day.
That's right.
You know what? So I dare you, man.
You release all that tension and then you get back to work and like your body is just pumping with hormones and things that are good for you because you got to let out all that frustration from the day before and you are just like, you are balanced now, right? And so then I find, going through a day of work where, and I try to like finish by a certain hour so I can do other things as well. Obviously not everything is work, but it is like being able to do that early on and then having the clarity of mind from early morning on until late allows me to power through emails and calls like nothing else. Like I have this rule where if I open an email, I have to reply, right? If I can't close it, it's too expensive for me to close it because then that means I have to reopen it again. So like what you do is you start installing these little safeguards to make sure your time is protected, and then you make sure that you don't overinvest in any one task specifically. You're always keeping a good flow of things around you and in your business. And so when you're making like 30, 40 calls a day, and there's also deals you got to submit, you got to call the lenders, you got to figure out if there's any kind of hiccups or problems with the transactions, right? Like when the day is over, I like to read. It's another way to break the cycle. It allows you to get out of that zone where you're fully focused on work. And then if you get it, especially good if you can, let's say, do reading for an hour and then do a little bit of running for an hour, do a little bit of yoga for 30 minutes, because your brain will break out of that cycle you started with better because you've been able to inject all these other activities into your brain that your brain wasn't doing earlier. And now it's sort of balanced. And now you can do other things and not feel anxious and stressed, right? And I think in jobs where you are doing high volume sales, especially, or high volume processing, you really need to be able to know how to zone out after the work is over. And if you don't know how to do it, you're going to be a very miserable man or a woman, whatever the case may be.
To wrap it up, a lot of people who listen and a lot of my clients in particular, are business owners, entrepreneurs, self-starters. What is one word of advice that you would give in just like an elevator pitch or 1 or 2 sentences that you've learned in your life that you feel would be helpful for other people?
Very simple. If you want a good life, it is all about the quality of the relationships in your life. So going back to what we're saying about hobbies, if you are able to build your life in a way where the relationships are meaningful and they're not just secondary, where you put effort into them, right? Like you do yoga because you also like the instructors and the group of people that you're a part of, and you look forward towards seeing them. Seeing people at yoga may not be the epitome of your life, but it is an important component in keeping your life feel healthy, right? And there is a bouncer next to where I live that bounces a club not too far. And there's one time I was walking by, we started talking, and he's a very interesting guy. He's a lot of perspective, and we just kind of got along. And so every time I would pass by to get like a slice of pizza or something, I would always stop by and say hi. It's a minute conversation, it's a minute engagement, but it sort of created this small little bit of meaning for the both of us, where the routine became a thing, right? So I would say that one of the most valuable pieces of advice I can give anybody is to keep your life full of meaningful relationships, because it makes your life really worth living, whether it's in business, because you like working with people that you work with. Nobody wants to work with people they don't like, right? Put more effort into making amends with your with your family and and people that are part of your cohort, so that you're feeling more comfortable where you live and where you are, and then the rest of the things just sort of fall in place.
Konstantin, thanks so much for coming, man. Appreciate it.
Thank you.
Thanks for listening. Don't forget to like, follow, and give us a review.